Hello, my dear students. A very warm welcome to all of you in Shri Jayendra Rank Zone. I am your friend and mentor for this subject, Principles and Practices of Accounting. In this lecture, we'll continue with Accounting Chapter 5, that is, Concept and Accounting of Depreciation. All the concepts will be covered in the coming series of lectures. This is lecture number 2. So let us begin. Let us begin. Just take a note. Quantum of depreciation. Quantum of depreciation. Quantum of depreciation. Give this heading. Quantum of depreciation. The first thing is basic principle. Basic principle. Just write along with me. Depreciation. Depreciation is allocated. Depreciation is allocated so so as to charge a fair proportion so as to charge a proportion fair proportion of the depreciable amount of the depreciable amount in each accounting period in each accounting period in each accounting period during the expected during the expected useful life of the asset during the expected useful life of the asset. Understood? Let us write point number 2. Considerations. Considerations. The quantum of depreciation. The quantum of depreciation to be provided the quantum of depreciation to be provided in an accounting year in an accounting year in an accounting year involves the exercise of judgment the exercise of judgment by management in the light of a technical a technical next you write commercial b commercial b commercial c accounting c accounting and d legal requirements and d legal requirements and D. Legal requirements, and accordingly and accordingly needs periodical review, and accordingly needs periodical review. Next point, revision in amount. Revision in amount. Revision in amount. If it is considered that if it is considered the original that the original estimate the original estimate of useful life original estimate of useful life of an asset requires requires any revision requires any revision, the unamortized the unamortized depreciable amount of the asset depreciable amount of the asset is charged to is charged to revenue is charged to revenue over the revised over the revised remaining useful life. Remaining useful life. Understood? Kindly write the next topic, and that is component wise that is component wise computation of depreciation. Component wise computation of depreciation. Please take a note. Companies Act Companies Act as well as accounting standard 10 on accounting standard 10 on property, plant and equipment property, plant and equipment, that is PPE, requires PPE requires depreciation requires depreciation to be charged on to be charged on a component wise charged on to be component wise basis component wise basis explained as under explained as under Right, first points the basic principle the basic principle. What is the basic principle? So each part each part of an item, each part of an item of PPE, property, plant and equipment, with a cost that is cost that is significant significant in relation cost that is significant in relation to the total cost in relation to the total cost of the item. Total cost of the item should be depreciated separately. Depreciated separately. Point number 2, treatment of parts. Treatment of parts. Treatment of parts. Give two headings. Part of item of PPE. Part of item of PPE. Inward here, write calculation of depreciation. Calculation of depreciation. Calculation of depreciation. First, write part with a cost, but this cost is significant. So in relation, significant in relation to total cost of the PPE, cost of the PPE item. Write an example, for instance, airframe and engines of an aircraft, whether whether owned owned or or subject to lease. This is the case. What would be the depreciation? So just write over here amount amount initially recognized in respect of such item is allocated is allocated to its significant parts significant parts and and depreciated separately and depreciated separately depreciated separately. Let us write point number 2. Point number 2, two significant parts of PPE Two significant parts of PPE are are depreciated separately, depreciated separately, and 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 the remainder, just erase it. Two significant part of PPE item, two significant part of PPE item having the same having the same useful life and depreciation method and depreciation method and depreciation method. How the goodwill should be calculated? Just write such parts may be such parts may be such parts may be grouped in determining the depreciation charge. The depreciation the depreciation charge. Please take a note of point number 3. Point number 3, significant parts of the parts of a PPE are depreciated separately, depreciated separately, 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 and the remainder and the remainder consisting of and the remainder consisting of the parts that are individually significant. They have individual significance also. Please write the calculation of depreciation. Approximation technique approximation technique approximation technique that faithfully represent that faithfully represent its its consumption pattern faithfully represent the consumption pattern and or useful life may be used. Understood? Let us move ahead now. Let us move ahead. Let us move ahead. Point number 4. Point number 4. Parts of PPE that do not have that do not have a significant cost that do not have a significant cost in relation to in relation to the total cost, in relation to the total cost of the PPE, total cost of the PPE. How to do the calculation? These may be these may be depreciated separately. These may be depreciated separately if the enterprise if the enterprise chooses so. Shift to the next point. Separable asset. Separable asset, that is land and building, that is land and building in which separable asset, that is land and building in which buildings 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 have a limited useful life, limited useful life, and land has an unlimited useful life, unlimited useful life, unlimited useful life. How to do the accounting of depreciation over here is accounted separately, even if even if they are acquired, even if they are acquired together, even if they are acquired together. Talking about land not depreciated, land not depreciated, buildings buildings depreciated, buildings depreciated. Write a note over here. Buildings depreciated. Write a note over here. Increase in increase in value of the land. Increase in value of the land on which a building stands. A building stands does not affect the does not affect the does not affect the determination of does not affect the determination of the depreciable amount, the depreciable amount the depreciable amount of the building, the depreciable amount of the building. Understood? Write point number 6. Let's move ahead and write point number 6. In case in case land itself in case land itself having in case land itself having limited useful life, having limited useful life. Example, queries queries and sites used for landfill, queries or site used for landfill. So in this case, what we will do, it is depreciated. It is depreciated in a manner. It is depreciated in a manner that reflects the benefits to be derived benefits to be derived from it. Next point, cost of land. Next point, cost of land includes cost of lands includes the cost of site dismantlement, removal, removal and restoration and restoration restoration. So that portion that portion of land asset is depreciated the period of over the period of benefits over the period of benefits obtained by benefits obtained by incurring these costs incurring these costs. Understood? The next topic is methods of recording depreciation. Methods of recording depreciation. Methods of recording depreciation. Methods of recording depreciation. Please write there are two methods. There are two methods of recording depreciation as follows as follows. The first method is by charging the first method is by charging for depreciation by charging for depreciation, that is accumulated depreciation account, that is accumulated depreciation account. The second method is by by creating provision by creating for depreciation provision for depreciation. Students, just make the correction over here. In the first point, just make it by charging to asset account. In the first point, just make it by charging to asset account. And in the second point, just make it by charging provision for depreciation by charging provision for depreciation slash accumulated depreciation account accumulated depreciation account. Okay. just write the next point, that is recording of depreciation, recording of depreciation, recording of depreciation by by charging to asset account, by charging to asset account, by charging to asset account method. Point number 1, by charging to asset account method. Under this method, under this method of recording, under this method of recording depreciation, depreciation is depreciation is directly depreciation is directly credited to respective respective asset account, respective asset account. Point number 2, respective respective asset account appears, respective asset account appears at its book value, at its book value, that is original cost, that is original cost less depreciation till date, less depreciation till date. Understood? And the third point, the various journal entries, the various journal entries which are passed, the various journal entries which are passed under this method are summarized as follows, are summarized as follows. Let us continue. Write journal entries, write journal entries. Let's make a table like this. Make two portions. Transactions, transactions, journal entries, journal entries. First transaction is to record purchase of an asset, to record purchase of an asset, purchase of an asset. The journal entry will be assets account debit, assets account debit to bank account, to bank account, being the asset purchased, being the asset purchased. Understood? This would be the journal entry, the first journal entry. Second, to provide depreciation. Second, to provide depreciation. How we will provide depreciation? So depreciation account debit, because depreciation is a nominal account. Debit all expenses and losses. It's a non-cash expenses. So depreciation to asset. The rule applicable on asset is it's a real account, credit what goes out. So depreciation account debit to asset account. Third entry, third entry to close depreciation account, to close the depreciation account. Entry is profit and loss account debit. Profit and loss account debit to depreciation to close the depreciation. Profit and loss account debit to depreciation. The narration could be being the transfer of being the transfer of depreciation being the transfer of depreciation account to P&L account being the transfer of depreciation account to P&L account. Understood? Next point. Next point. The next is the next is to record the next is to record sale of asset. The next is to record sale of asset. When we sell the asset, we'll get funds in bank account. So bank account debited to asset account. Bank account debited to assets account. The narration could be being the assets sold. Being the assets sold. Being the assets sold. Next, the last one, to record profit or loss on sale, to record profit or loss on sale. So in case of profit, what would be the journal entry? In case of profit, assets account debited to profit and loss account. Assets account debited to profits and loss account. You can write the narration being the transfer being the transfer of profit on sale on sale. The next is in case of loss. The next is in case of loss. So profit and loss account debited to assets account to assets account. You can write the narration being being the transfer of being the transfer of loss on sale being the transfer of loss on sale. Let us write some notes. Write a note over here. First, book value. First, book value. Book value as on date of sale. Book value as on date of sale equal to original cost equal to original cost minus minus total depreciation minus total depreciation till date of sale till date of sale. Book value as on date of sale equals to original cost minus total depreciation till date of sale. The next, profit. Profit equals sales proceeds minus book value as on date of sale as on date of sale. Third, loss equals book values as on date of sale minus sales proceeds minus sales proceeds. So this is the formula for sales. This is the formula for profit and loss. Profit equals sales proceed minus book value as on the date of sale, and loss equals book values as on the date of sale minus sales proceeds. Next, in case of exchange, in case of exchange of an asset, in case of exchange of an asset, sale proceeds sale proceeds imply the sales proceed imply the trade in allowance trade in allowance. What is trade in allowance? The amount at which the amount the amount the amount at which the vendor agrees the vendor agrees to acquire the old asset to acquire the old asset acquire the old assets. Next next in case of next in case of destruction in case of destruction or damage in case of destruction or damage of an insured asset destruction by fire or damage by fire, or it could be an accident. Sale proceeds sale proceeds sale proceeds imply claim claim admitted by insurance company claim admitted by insurance company together with salvage value together with salvage value if any. So in case of destruction or damage of an insured asset by fire or accident, sale proceeds imply claim admitted by the insurance company together with the salvage value if any. Let us move ahead now. Let us move ahead now. Write the next point, that is methods of allocating depreciation. Methods of allocating depreciation. There are several methods. There are several methods there are several methods of allocating depreciation. There are several methods of allocating depreciation over the useful life of an asset. Over the useful life of an asset. Those those most commonly those most commonly employed in industrial industrial and commercial industrial and commercial enterprises are are the straight line method, are the straight line method, are the straight line method, that is SLM, and the WDV, that is written down value method. Written down value, written down value method, that is WDV. Got it? Fine. Still take a note of all the methods and then we'll begin with the methods. The following methods, the following methods, the following methods, the following methods are available for computing, for computing and allocating and allocating the the depreciable amount, allocating the depreciable amount of an asset, of an asset over over its useful life, over its useful life. What are the methods? So the first method is straight line method, straight line method, which is also known as fixed installment method, fixed installment method. Next, next, reducing balance method, reducing balance method, reducing balance method, or written down value method, or written down value method, that is WDV. RBM, this is known as RBM and WDV. The next method is the next method is the next method is sum of digits method, sum of digits method. The next method we'll learn is machine hour method, machine hour method. The next method we'll learn is production units method, production units method. The next is depletion method. The next method that we will learn is depletion method. G. Annuity method. Next method is annuity method. Annuity method. The next method is sinking sinking fund sinking fund method, sinking fund method, sinking fund method. Write a small note over here in relation to this. So of the above, the first two methods, the first two methods, that is straight line, that is straight line and reducing balance method and reducing balance method reducing balance method are are widely used are widely used are widely used. Understood? Let us move ahead. Let us move ahead. The next topic is selection of method. The next topic is selection of method. So basically, what is the basis of selection of method? The choice, the choice, the choice of a method is based on the choice of a method is based on A. The type of asset, the type of asset, B. B. Nature, nature of its use, A. Type of assets, B. Nature of its use, and C. Circumstances, circumstances prevailing, circumstances prevailing in the business, circumstances prevailing in the business, circumstances prevailing in the business. Write a note over here. Write a note over here. A combination, a combination of more than one, a combination of more than one method, more than one method may be used. A combination of more than one method may be used. Next is depreciable asset. Please shift to the second point. Depreciable assets. Depreciable assets. Depreciable assets not having depreciable assets not having any material value, not having any material value are are fully depreciated are fully depreciated in the year in the year in which in the year in which they are acquired in the year in which they are acquired in the year in which they are acquired. Next point, the income tax, the income tax rules prescribes the income tax rules prescribes the written down value method, the WDV method, that is that is reducing balance method, that is reducing balance method, that is reducing balance method, except except in the case of except in the case of an undertaking, except in the case of an undertaking engaged in undertaking engaged in generation generation and distribution of power, generation and distribution of power, generation and distribution of power. Let's move ahead. Let's move ahead. Okay, we need to learn a difference. We need to learn a theoretical difference in this chapter, and that is the difference between depreciation and fluctuation in value. Depreciation, depreciation and fluctuation in value, and fluctuation in value. What is the difference between depreciation and fluctuation in value? Make three columns: fluctuation in value, depreciation in value, and particulars. Particulars. Particulars, depreciation in value, depreciation in value, fluctuation in value, fluctuation in value. The first pointer is the meaning. The first point is the meaning. So basically, depreciation is a measure of the wearing out, consumption, or other cost of the value of depreciable asset arising from use, efflux of time, or obsolescence. Let us write over here: depreciation. Depreciation is a measure. Depreciation is a measure of the wearing out, measure of the wearing out, consumption, wearing out, consumption, or other loss, or other loss of value of a depreciable value of a depreciable asset arising depreciable asset arising from use, efflux of time, that is passage of time, efflux of time, or what, obsolescence, or obsolescence through through technology, through technology and market changes, through technology and market changes. I believe you understood. Let's learn about fluctuation. So fluctuation is a temporary shrinkage or decrease or decrease or increase in the value, decrease or increase in the value of an asset, usually usually due to external causes, due to external causes such as such as such as such as such as rise and fall, such as rise and fall in market price, rise and fall in market price of an asset, of an asset. I believe you understood this. Let us go to the next point: earning capacity. Earning capacity. Kindly take a note of it. Earning capacity. It directly affects the it directly affects the earning capacity earning capacity of an asset of an asset. It does not affect does not affect the earning capacity the earning capacity of earning capacity of working life of an asset working life of an asset. I believe you understood. Working life of an asset. Let's move ahead. Let's move ahead. Effect in profit and loss account. What is the effect in profit and loss account? It is a charge. Depreciation is a charge against the profit. Depreciation is a charge against profit of the year. That means what? That for the proper ascertainment or for the true and fair view of the financial statement, the depreciation must be included in the profit and loss account, and depreciation should be charged on the non-current assets. The next is no charge is made no charge is made against against the profit. No charge is made against the profit of the year. For fluctuation, we do not make any charge against profit or income statement. No charge against fluctuations. I believe you understood. I believe you understood this. Next, type of assets. Next is type of assets. Next is type of assets. It is it is connected with fixed assets only. It is connected with fixed assets only. Depreciation is connected with fixed assets or non-current assets only. Next is it is connected with it is connected with it is connected with fixed assets. It is connected with fixed assets as well as current assets and current assets. Next point, direction of change. Direction of change. Please write direction of change. In depreciation, please write it is it is associated with it is associated with a reduction in the value. It is associated with reduction in the value of fixed assets. Reduction in the value of fixed assets. In fluctuation, just write it may relate to it may relate to increase it may relate to increase or decrease it may relate to increase or decrease in the value of in the value of any asset, whether that asset is a fixed asset or a current asset. Any asset that is fixed asset or fixed assets or current assets or current assets. I believe you understood this. Let's get to the next topic, and that is calculation of depreciable amount. Calculation of depreciable amount. Just write over here depreciable amount. Depreciable amount. Just try to understand this. Depreciable amount is determined as under is determined as under. How we will determine the depreciable amount? Make a table. Particulars amount in rupee. Just make it particulars and amount in rupee. Cost of an asset. Cost of an asset or other amount. Cost of an asset or other amount substituted substituted for substituted for cost in the financial statements. In the financial statements, cost of an assets or other amount substituted for cost in the financial statements will make a total of it will make a total of it less less estimated residual value. Estimated residual value. Estimated residual value. What we get over here is depreciable amount. What we get over here is nothing but depreciable amount. Depreciable amount. Understood? Write an example over here. Write an example in relation to this. An example, an item of machinery, an item of machinery was was purchased by Anu Limited for rupee 18 lakhs. For rupee 18 lakhs. It can be it can be sold for it can be sold for rupee 13.5 lakhs currently or or for for rupee 2 lakhs after 8 years. After 8 years. What is 8 years? Which is, please write, which is the useful life, which is the useful life of the asset. That means the useful life of the asset is 8 years. 8 years. Understood? The depreciable amount, the depreciable amount of the machinery, the depreciable amount of the machinery will be will be rupee 18 lakhs minus rupee 2 lakhs, that is estimated scrap value, equals equals rupee 16 lakhs, equals rupee 16 lakhs. Please write one more line over here. The current selling price, the current selling price of the asset or of the machinery is irrelevant, of the machinery is irrelevant, of the machinery is irrelevant. I believe you understood till here. We are stopping here. We are stopping here. We'll continue in the coming lecture. Thank you. Thank you.